Inflation doesn't just raise prices. It changes behavior, politics, and power. Why do governments sometimes prefer inflation over recession? In theory, both inflation and recession are bad. But when policymakers must choose between the two, they often tolerate inflation longer than they tolerate economic contraction. Because inflation spreads pain quietly. Recession concentrates pain visibly. Governments don't just manage economics. They manage stability. 10 reasons governments often prefer inflation over recession. 1. Recessions create immediate unemployment. A recession leads to job losses quickly and visibly. Unemployment rises, businesses close, and public anger grows. Inflation, by contrast, erodes purchasing power slowly. Politically, slow pain is easier to manage than mass layoffs. 2. Inflation reduces the real value of debt. When prices rise, the real burden of government debt falls. If a country owes a fixed amount, inflation makes that debt cheaper in real terms. Recession does the opposite by shrinking tax revenue while debt remains fixed. 3. Economic contraction shrinks tax revenues. During recession, income and corporate profits fall, reducing government tax collection. This worsens deficits and forces austerity or more borrowing. Moderate inflation, however, often increases nominal tax receipts. 4. Financial systems struggle more during deflation. Falling prices increase the real value of debt, making defaults more likely. Banks suffer losses, and credit tightens further. Inflation helps debtors manage obligations more easily than deflation does. 5. Asset markets react worse to recession. Sharp economic contraction can trigger stock market crashes and credit crises. Governments often try to avoid financial instability, even if it means tolerating higher inflation temporarily. 6. Voters react faster to job loss than price rises. While inflation frustrates households, unemployment creates immediate hardship and visible distress. Politically, unemployment is more dangerous than gradual price increases. 7. Central banks have tools to fight inflation. Policymakers believe inflation can be managed later through rate hikes and tightening. Recession, once deep, is harder to reverse quickly. This creates a bias toward tolerating inflation before aggressively stopping it. 8. Inflation can be blamed on external factors. Governments often attribute inflation to supply shocks, wars, or global disruptions. Recession, however, is often seen as domestic policy failure. 9. Nominal growth makes economies look stronger. Inflation increases nominal GDP. Even if real growth is weak, higher nominal figures can improve debt to GDP ratios and create the appearance of expansion. 10. System stability is prioritized over purchasing power. Governments focus on maintaining social and financial stability. Moderate inflation, though painful, may be seen as less destabilizing than widespread bankruptcies and unemployment. Final truth. Governments do not love inflation. But when forced to choose, they often see it as the lesser evil. Inflation spreads pain quietly. Recession concentrates pain instantly. That political reality shapes economic policy more than most people realize.